Let me take you back exactly 97 years to a place called the Florida Everglades. In the late 1920s, thousands of ordinary people were clutching paper deeds to land they had never actually seen. They were told this swampland would be the next Miami Beach. Developers promised returns of 300 or 400%. Banks were handing out loans like candy. For a few glorious months, it actually worked. People were flipping land contracts and making fortunes on paper. Everyone believed they had discovered the secret to effortless wealth. Then the hurricanes came. Not just literal storms, but the financial kind. Land values collapsed, banks failed, and those paper fortunes evaporated overnight. The cruelest part was that the developers had already cashed out months earlier. They knew exactly what was coming. Now, as we stand here in the year 2026, many people are making the same fundamental mistake. They are holding on to a story rather than a reality. You might be sitting on some capital right now. Maybe you have saved up $100,000. Maybe you inherited it or sold a business, and you are trying to figure out the smartest way to grow it without falling for a modern-day swampland scheme. By the end of our discussion today, you will understand the exact mechanism that separates people who build real wealth from those who just think they are wealthy until reality catches up. I am going to show you precisely how investing $100,000 across the 3 best index funds actually plays out over time. But more importantly, I am going to reveal why most people get this completely wrong, even when they think they are doing everything right. Before we dive into the math and the specific funds, I want to hear from you. What is your biggest concern about the economy in 2026? Is it inflation, the housing market, or something else entirely? Please leave a comment below so we can discuss it together. And if you find this perspective valuable, please hit the like button and subscribe to the channel. It helps this information reach more people who truly need to see it. Now, why does that Florida story matter so much to what you are doing with your money today? Because most people today are investing in a narrative about endless growth. They think they are diversified simply because they own an index fund. But just like those investors in the 1920s, they might be buying an idea of certainty in a very uncertain world. Let us look at the 3 funds that most experts recommend for a well-rounded portfolio. First, a total United States stock market index fund, often referred to as VTI. Second, an international developed markets index fund, known as VXUS. Third, a total bond market index fund, or BND. On paper, this looks like the perfect plan. You are investing in thousands of companies across the entire globe. But there is a concentration risk that is not immediately obvious. Take the S&P 500 as an example. It sounds diversified because it holds 500 companies. But as of 2026, the top 7 companies, often called the Magnificent Seven, make up a massive portion of the entire index. We are talking about Apple, Microsoft, NVIDIA, Amazon, Meta, Alphabet, and Tesla. When you buy a total market fund with your $100,000, you are not buying 500 equal positions. You are buying a portfolio that is heavily tilted toward a handful of tech giants. If those companies stumble, your supposedly diversified portfolio becomes a lot less diversified in a hurry. Think about a restaurant that has 30 items on the menu. It looks like they have many revenue streams. But if you look at the sales data, you find that 7 dishes generate 80% of the revenue. If a food trend shifts, that restaurant is in serious trouble, despite having a long menu. This is exactly what is happening in index funds today. The financial industry benefits when you pour money into these products without thinking too hard. They charge fees based on assets under management. The new money that flows in, the more they earn. They have very little incentive to explain that your total market index is actually a tech-heavy bet. Now, let us get into the actual math of what happens when you invest that $100,000. Imagine you allocate your money using a classic 60-40 split. $60,000 goes into the United States stock market, $20,000 goes into international stocks, and $20,000 goes into bonds. Over the last few decades, the United States market has returned roughly 10.3% annually. International stocks have returned about 5.6%. Bonds have returned about 4.7%. Using this allocation, your expected annual return is roughly 7.9%. That sounds great on a spreadsheet. Your $100,000 growing at nearly 8% a year becomes over $200,000 after 10 years. After 30 years, you are looking at nearly $1 million. But here is the brutal truth that most people ignore. Those are nominal returns. They do not account for the silent thief called inflation. If inflation averages 3% annually, your real return is not 8%. It is closer to 4.9%. Let us compound that forward in terms of actual purchasing power. That $1 million you hope to have in 30 years will not buy what $1 million buys today. In today's purchasing power, that $1 million will only be worth about $412,000. It is still a fantastic return. You have quadrupled your real wealth, but it is a far cry from the millionaire fantasy most people have in their heads. This is the psychological trap. People see nominal numbers on their screen and feel rich, but they forget to ask what those numbers can actually buy at the grocery store or the car dealership. If you are finding this breakdown eye-opening, please take a second to like this video. It really helps the channel grow and reach more investors. There is another factor we must discuss, and it is called behavioral alpha. This is the extra return you generate simply by not being your own worst enemy. Studies show that while a fund might return 8%, the average investor in that fund only gets 5 or 6%. Why is that? It is because people buy when they are excited and sell when they are terrified. They see the market soaring in 2026 and they pile in at the very peak. Then, when a correction happens, they panic and sell at the bottom. This behavioral gap can cost you millions of dollars over a lifetime. Over 30 years, if you lose 2% a year to poor timing, your final wealth could be cut in half. You literally leave a fortune on the table because you reacted to your emotions instead of the math. The good news is that this is entirely within your control. You do not need to be a genius or a math whiz. The investors who build real wealth are the ones who can override the instinct to run from danger. Losing money feels like physical pain to our brains. Volatility is the price you pay for long-term gains. If you cannot accept that price, you should not be in the stock market. Let us talk about the sequence of returns risk. This is the idea that the timing of your returns matters as much as the amount. If you invest $100,000 and the market drops 30% in the first year, you are in a much worse position than if that drop happened in year 20. This is why I always recommend segmenting your money. Think of it in 3 distinct buckets. The first bucket is for money you need in the next 2 years. This stays in cash or very short-term bonds. The second bucket is for money you need in 3 to 10 years. This can be a conservative mix of stocks and bonds. The third bucket is for your long-term retirement, 10 or 20 years away. This can be more aggressive because you have the luxury of time to recover from any storms. Most people mix all their money together and end up with an allocation that is too risky for their short-term needs. They get forced to sell during a crash because they need the cash for an emergency. That is how you destroy a lifetime of progress in a single week. I also want to address the debate about international stocks. Many people in the United States wonder if it is even worth it to invest globally. Over the last 15 years, American stocks have dominated. But as of 2026, United States stocks are quite expensive by historical standards. International stocks are relatively cheap. In investing, buying expensive assets and avoiding cheap ones is usually a recipe for lower future returns. You do not diversify for what you expect to happen. You diversify for the things you cannot possibly predict. The international portion of your portfolio is your insurance policy against a prolonged slump in the United States economy. As we look toward the future, remember the concept of enough. Most people never define what enough means to them. They just want more. And the problem with wanting more is that more never arrives. When your account hits 500,000, you will want $1 million. When it hits $1 million, you will want $2 million. This is a treadmill that leads to unnecessary risk-taking. If you define your number today, you can begin shifting towards safety as you approach it. You can stop playing the game once you have already won. Building serious wealth through index funds is not about luck. It is about patience and understanding the system. Your $100,000 left alone in these 3 funds will almost certainly grow into something substantial. Not because you are a genius, but because you understood the game well enough to keep playing when everyone else quit. That is the real secret. It is hard to do nothing when the world feels like it is falling apart. But doing nothing is often the best strategy you have. Before you go, I want to ask you one last thing. Have you checked the actual holdings of your index funds lately? Go look at how much of your money is tied up in just those top 7 tech companies. It might surprise you how much of your future depends on them. If you enjoyed this deep dive, please leave a comment with the word perspective so I know you stayed until the end. Do not forget to like the video and subscribe for more honest financial analysis. Thank you for spending this time with me. Invest with your eyes open, and I will see you in the next one.